Hello, and thank you for joining us on our webinar series, 10 Questions with Reunion. My name is Billy Lee, and I'm the president and co-founder of Reunion, the leading marketplace for clean energy tax credits. We work with corporate finance teams to purchase tax credits from solar, wind, battery, and other clean energy projects. Today, we are joined by David Kinzel, Vice President of Structured Credit and Political Risk at Marsh. I'm really excited to speak with you, David, because risk management, that is the comprehensive identification and proper allocation of risk, is core to the tax credit marketplace. And innovations around risk management is critical to keep growing this market. So let's get into it. David, for starters, can you just tell us who you are, what you do, and where this webinar finds you today?
Yeah, thanks, Billy. Really appreciate you having me here today. I am part of Marsh's, what we call our credit specialties division. So for those who don't know, Marsh is the largest insurance broker in the world. But we have teams that are specialized on these niches within the insurance world, mine being credit and political risk. So I've been working in the world of credit risk for over 15 years and have a lot of experience in political risk, but that's an interesting topic for another day.
And David, where are you calling in from?
I'm based out of Denver, Colorado.
Excellent. So, insurance in the context of tax credit transferability usually focuses on tax credit insurance, where an insurer is covering the risk that a tax credit is disallowed or recaptured by the IRS. With transferable tax credit, this insurance is important because generally buyers bear this risk, and sellers often do not have the balance sheet wherewithal to stand behind their indemnities. However, you and I had a really interesting discussion the other day where we talked about how credit risk insurance could also be applied to tax credit transfer transactions, specifically in the context of forward commitments. Can you provide some detail here?
Absolutely. Yeah, very interesting dialogue we had. And just to be clear, credit insurance is very different from what our talented tax credit insurance team does, right? So what we're thinking of is more of almost a credit enhancement on the tax credit buyer. So if we just take a step back to get a little bit more context, so credit insurance basically covers the default of a financial obligation. The market has been around for years, but it's been evolving over the past decade or so. So now we've been looking into, more complex transactions beyond more short-term trade receivables. We've been looking at ensuring the default of a project finance loan. We've been looking at ensuring offtake agreements. So under a power purchase agreement, that's credit risk as well. So it's just a creative and evolving segment of the insurance world. When we look into tax credits and the transferability, we're thinking of, again, credit enhancement for the transfer of the tax credits for the forward commitment made by the tax credit buyer. So we're basically just ensuring that financial commitment of the tax credit buyer. From our understanding, and again, from our discussions, it seems like there's the lenders, whether it be bridge lenders or construction lenders, have almost like a binary view of the credit risk for the tax credit buyer, where they say, okay, if that tax credit buyer is investment grade, we could fund the project. If they're not, then you need to find a new tax credit buyer. So we see this as an opportunity to really open up the universe, if you will, of tax credit buyers that would be eligible.
So basically, what we're saying is in the scenario where a developer is seeking a forward commitment to sell their tax credits to a buyer, that is, I'm starting construction on a project that's going to take 2 years, and I want a buyer to be there in 2 years to buy these credits, but I want a contract now. um, the credit of that buyer is important because typically a developer is entering into that contract to ultimately finance that bridge loan. So it's interesting where we have buyers who may not be as creditworthy. Then this is where your product might come in handy.
That's exactly right. Yeah, perfectly said,
Got
Billy.
it. Got it. And so, how deep is this market? And maybe it's not deep today, but how deep do you think it can become?
Yeah, yeah. So this is, I mean, like you said, it's a new area. It's all kind of evolving as we go, so it's hard to give too much concrete numbers. But we're very engaged as Marsh in building out this market. There's a lot of insurer interest. A lot of the insurers have expressed the interest in kind of diving into this market, and once they understand more into insuring these risks, I think it's going to be more of a short-term and a long-term type approach, right? So when we say short-term, initially, insurers are probably going to have more appetite for vanilla transactions. We're thinking ITCs just because the shorter term duration of the risk that they would be taking on. But we're thinking there could be anywhere up to 100 million per transaction. So 100 million of tax credits or commitment could be insurable, which from my understanding should cover the majority of the transactions that are going on today or in the near future. But when we look to the longer term, I think there's going to be a lot more appetite for more complex transactions. PTCs could be something that are eligible, again, given their longer term nature of credit risk.
Got it. Got it. Very interesting. What would the underwriting for a credit transaction of this type look like? And what would the diligence be? I imagine it would be much different than your typical tax credit insurance.
Absolutely. Yeah. So again, it's evolving, but initially we're thinking that underwriters are going to take a very conservative and traditional view of the risk. And what I mean by that is they're really going to just dive into the credit risk of the tax credit buyer by looking at audited financials, how creditworthy are they to make this decision? Is there anything coming up that could impact that ability to make that investment when the time comes and the tax credits are available? So that's going to be ultimately that's going to be kind of the first layer that they're going to look at, right? You have to pass that test. And then once they start to drill deeper, they're going to start looking at, okay, what about the developer? Do they have a good reputation? Are they reliable? That's something that's going to come into play. They're definitely going to look at the duration of the forward commitment. So obviously a 6-month commitment is going to be quite a bit different than a 24-month commitment. So that duration from the time the tax credit transfer agreement is signed to the time that the tax credits are actually transferred is going to be part of the analysis that goes into it. And what we've had some of these conversations, and a lot of people want to know, okay, are they going to dig into the underlying contracts? Are they going to want to see all these contracts and get into the details? The answer is no. They're definitely going to want to see portions of the tax credit transfer agreement, but it's important to clarify that they're ensuring the default of a legally enforceable obligation. So if for some reason there's a situation where one of the tax credit buyers says, okay, actually we found a way to back out of this commitment because one of the clauses within the agreement, the insurers aren't looking to provide protection for a bad contract. So that's where it's important to just make that clarification and distinction. It's also important to say, the underwriters are probably going to look at what advisors are involved in these transactions. If there's advisors like yourself that have a lot of experience in structuring these transactions and getting clean documents together, that's going to give them comfort as well. So there's no issues later on down the road to deal with.
Got it. Got it. Very, very interesting. So if this market does develop, you mentioned something interesting about them analyzing audited financials and credit. And I guess the question is, could any tax credit buyer be considered an insured? And if a potential buyer has to have some minimum level of credit, does that kind of defeat the purpose of insurance? If you have credit already, why do you need a credit enhancement? So maybe you can touch on those questions.
Yeah, that's a really good questions there. The answer is no. So not every tax credit buyer would be considered insurable, but I don't believe that defeats the purpose of the insurance, and I'll explain why that is. But so again, in the short term, what we're expecting is the insurer appetite is going to be for more S&P double B risk. So one notch below investment grade is probably where there's going to be the most appetite, right? And this also is good for privately held companies, companies without publicly rated debt. That is something that the credit insurance market is very comfortable with. I mean, basically, again, looking at financials and backing into an implied rating is something that they're doing on a very regular basis. So that's not going to be a problem. But where we get excited is when we've done some analysis of S&P data, and we looked at kind of, okay, what is the universe of all the rated entities in the United States? And so if you look at who is investment grade, there's approximately 1,200 investment grade issuers in the United States, right? So that says, okay, the potential universe of companies that can invest in tax credits on a forward commitment is around 1,200, right? So a big number, but what could we do differently? If we say, okay, if we go down the credit curve and say, okay, now double B entities are going to be eligible, maybe even single B entities. That adds another estimated like 1,400 entities that could be eligible. And then on top of that, we start looking at privately held entities that don't have public debt. If we look at US subsidiaries of a foreign parent, the parent may be investment grade. Maybe they don't want to give a parental guarantee. There's so many situations where this could come into play. And we're just seeing it as an opportunity to really expand the universe of potential buyers well beyond what it is today and just add a lot more liquidity into the market.
Got it. So that's really interesting numbers. So we're off the bat, we're immediately at least doubling the potential universe of buyers. That's great. We need more of that type of thinking and creativity. How would a policy like this be structured, just from a very mechanical standpoint?
Yeah, so I'm going to keep this really simple, but essentially there's going to be three parties that would be involved. So first would be the developer. The developer would be the insured, right? So they're going to be the ones that would be the insured on the policy. The second party would be the insured counterparty. So that's going to be the tax credit buyer. So that's the party that could actually trigger a claim by defaulting on the legally enforceable obligation that we talked about. And then the third would be the lender. So the lender would be what's called a loss payee. So they'd be named on the policy. Essentially, they would, if there was a claim paid, they would have rights to the proceeds of a claim, giving them that comfort of, why the policy is there in the first place. But it could be triggered by a number of different things. But just again, taking an example of, say there's a 12-month forward commitment, and maybe the tax credit buyer files insolvency on month 6. That's something that would trigger a claim, right? And the second kind of scenario could be maybe the tax credits are transferred and there's some kind of agreement to pay after the transfer event. If there's payment terms like that, that would trigger a claim as well. So really anything where the tax credit buyer defaults on that contract that we're essentially wrapping in insurance, that's where claims would be triggered. And those are kind of how it would be structured from a general level.
Got it. Got it. Okay. And then we also spent some time talking about how an insurer could step into the shoes of a buyer in the event of a claim, which I think is really interesting. Could you explain this arrangement, and would an insurer then need to have privity to the purchase and sale agreement? Would it become a three-way, tax credit transfer agreement?
Yeah, it is interesting. And I mean, we've talked a lot about the underwriting process and how that works kind of based on credit quality. But another important factor that the insurance market takes into account here is the potential for recoveries. And so once an insurance company pays a claim, it's not like they sit there and say, we made a bad decision, let's move on to the next one. They are going to be going back and looking for recoveries in any way that they can to minimize their loss, right? That's part of their process. So there's kind of three ways that they can go through that. So the first, they would probably go after the tax credit buyer, again, under their breach of that legally enforceable obligation to commit the capital. That would be their first step, is to go after that tax credit buyer for the funds that they paid a claim on. If they aren't successful there, there's going to be a situation where they'd say, okay, we have the expectation of the developer to help us find a new buyer for the tax credits. So to minimize that loss by finding a new buyer in the market, however that could happen, that would be kind of step two. But the third step is the interesting thing that we talked about is, okay, there could be a situation where the insurer may say, all right, we paid a claim, but our recoveries could be in the form of a tax credit. So finding a way to say the tax credits have not been transferred yet to the original tax credit buyer. There's not a buyer anymore because they defaulted on that contract. Could the insurance company step in and say, okay, we're going to take those tax credits for ourselves? I mean, this is something we're exploring and talking about, and it seems very possible.
Right, because if you give insurers more backup options to ultimately recover, the more willing they will be to extend that coverage, and perhaps the coverage will cost less, theoretically. Correct?
Exactly, exactly. I mean, that could impact the cost. That could impact again how far down the credit curve we can go. There's a lot of implications as the market develops. If the insurers get good experience and get very comfortable, it could really open up the universe of who would be eligible to be insured as a tax credit buyer.
Great. So the immediate follow-up question, and my last question, is, the $1 million question is, how much does this insurance actually costs today? And obviously there's probably been very few data points, but how much do you think this coverage will cost over time? Will it go down as more of these policies are written?
Yeah. So that's always the question, right? So the market's developing. I think there is going to be quite a bit of variation based on the risk with all those underwriting factors that we talked about. But we know the market really well. We've been in this market for a long, long time. I think a good kind of starting point is around an annualized 1% on the commitment amount that's going to be insured. And that, again, that could go down as we see better credit quality, more comfort from insurers. I would expect that to go down for the higher credit qualities and the shorter duration risk. Whereas if we look at, again, going down the credit curve to more challenging credits and longer durations, then it could be above that kind of 1% annualized threshold. But that's a good base case estimate if people are just looking to kind of explore this at a high level, is around, again, annualized 1% on that commitment amount would be around where we would expect.
Got it. David, this has been a great conversation. I love connecting with thought leaders and innovators in the spaces, particularly around risk management. So thank you for your time. Thank you for tuning in to 10 Questions, and we'll see you next time.